Hello, this is Dr. Oz. In this video, I will show you how to create a portfolio based on price from A to Z. So it's going to be a long video. However, I think you are going to enjoy this video. So first, I Googled S&P 500 stocks, and then I got the list of stocks, and I will pick the stock that I like. Again, you can choose any public traded company. Let's say I like 3M. I create a new tab here. Yahoo Finance. I would like to download their stock price data. Okay, you will see here historical data tab. Click on that. And now I would like to have last 5 years data. 5 years. The computer is a little slow. Let me just do it again. Click on historical data. And then you see here time period. I click on that and I click on 5 years. And now I would like to have monthly data because daily data has so much randomness, so much noise. And I click apply. Now I can download 3M's data for the last 5 years. I really like this analysis right now because we are in the middle of coronavirus after 11 years of bull market. So we will see good and bad and ugly in one analysis. Let's say I would like to have more companies, and let me take a look at here what I like. Let's say I would like to put AT&T in my portfolio. So I click on, I can go to Yahoo Finance and type AT&T. Ticker symbol is T. Click on that. Now here again, historical data. And I will again choose 5 years. And again, I will choose monthly data. Click apply. Download the data. Now I have AT&T as well. Let's add a few more companies. Let me see whether is there any other company that I like here. Obviously, these are the best companies in the world, pretty much. Another one I like is BNY Mellon. Let's click on BK in Yahoo Finance. I will type BK right here. And I will click on historical data again. Last 5 years. Monthly. Apply. And download the data. Let's download a couple more. Let's see. What else do I like here? Let's put Chipotle. It's kind of a nice place to go. I like to go to that restaurant a lot. Which is CMG. Let's click on that. I need to reconnect to my remote desktop. Accidentally I logged off. Okay, perfect. Let's download Chipotle as well, which is CMG. CMG. Perfect. Okay. Let's go click on historical data. Scroll down. Five years data. Monthly. Apply. Download data. I'm trying to choose different companies from different industries as well for fun. So let's go to oil company. They're in big trouble nowadays. Oil prices around $30. Very, very cheap. CVX. Let's see what's going on there. CVX. I just want to show you how bad is coronavirus. Look at this now. We look at CVS. And let's take a look at the chart for 1 year. You see what's going on. The price was around $126. Now CVX is $83. Literally 30% off. We go even more. You can see here actually the stock price for CVX was $130 in 2014. So almost half price in 6 years. So oil companies are having a hard time. All right, so now what I would like to do is download data for CVX as well. Last 5 years. And monthly. Apply. And download data. Again, you can have more companies to have better results, but I think for illustration purposes, 5 companies should be enough. So I will look at these files in a folder. I will save these files, Control X, in my H drive to make sure that I'm not going to lose my files. I will just put it here, new folder, portfolio long video, because I'm gonna go again from A to Z. Maybe I shouldn't call long and people may fall asleep. Portfolio A to Z video. And I will save everything in this folder. Let me just look at this again, copy those files. Looks like I lost them on the way. All right, let's do Shift, click, Control X, close this, and then for the A to Z, boom. All right, so now since I have these data files, I would like to create my portfolio. Let me just create a new Excel file here. Let's call this one as zero portfolio based zero. My computer is doing weird things. Zero portfolio based on price for A to Z. All right, so let's go into this Excel file. All right, now let's create a Excel sheet here labeled as historical data. Historical. Okay. Now let's copy our data. Let's start with the BK. Let's copy the date column, Control Shift down arrow, Control C. And Control V. So it didn't work. Let's try again. Control C. Control V. Okay. Double click here. Now let's get the adjusted close values, because this includes the dividends and splits. Control Shift down, Control C. Control V. Let's label this as BK. Perfect. We can close the CSV file for BK. I don't want to have more than one Excel file because, again, simulations are CPU intensive, and I don't want to have I don't want to burn my computer. That was for BNY Mellon. Now let's go to the Chipotle. Open up the CSV. Again, I would just get the adjust close column, Control Shift down, Control C. Go back to my portfolio file, Control V. Didn't work. One more time. Control C, Control V. Again, this is CMG, which is Chipotle. Prices. Let's close the CSV file as well. Right. Let's go to the next company, which is Chevron, CVX. Get the adjust close. Control C, Control V, CVX, Chevron. Let's close this file. CSV file again. Close, right click, close. And make sure that you save your file periodically in your H drive by clicking over here or Control S. Let's go to our next company, which is 3M. Again, adjust close, Control C, and go back to our portfolio, Control V. Again, this is MMM. Let's go right click here, close window, final company AT&T, CSV file, adjust close, Control C, Control V, didn't work. One more time, Control C, go back to our Excel file, Control V, Control S to save, and we can close the right click AT&T as well. So now we have our historical data for 5 companies, and you can see these are dollars. So I click here, Control Shift right arrow, Control Shift down arrow, and then make them all dollar to make it easier to read. All right, so you can see that stock prices were going pretty good in general. However, recently we have big issue with the coronavirus. Normally I like to delete the last row because it's not a full month, but I will keep it this time because I think let me see, actually let's delete it. Let's keep it consistent, because again, this is not a full month. Let's keep things consistent. Right click, delete. All right, Control S to save it. So now, based on these historical data, I would like to calculate my growth rates for the 5 years, historical years. I click on this plus, new Excel sheet, growth rate, 5 years. And now, go back to historical. I will basically click on A1, Control Shift right arrow, Control Shift down arrow, Control C, go back to growth rate 5 years, top left corner, Control V, and click on top left corner to select the entire sheet between two letters, double click to adjust the width, and now I can delete these dollars, Control Shift right arrow, Control Shift down arrow, and delete button, not backspace, delete button. Now I can calculate growth rates. Obviously, I will lose 1 month of data because I need to calculate growth rate for next month. I need 2 months of data. This growth rate will be May 1st, 2015 divided by April 1st, 2015. If this value is greater than 1, which in this case it is, stock price increased. If it's less than 1, stock price decreased. Looks like I did not label my last company, which was, let's double check, T, which is AT&T. T here. And T here. All right, so now I can drag this one to the right down corner, across, double click. All right, so now I got all those growth rates as well, okay? So all I did is just convert those prices into growth rates. I really don't need the first row. I can delete this. All right, now what I'm gonna do is I will create a new sheet and I will call this one as forecast. This is where I will do the magic. Forecasting the future. Control S to save it. So now what I would like to do is I would like to find the best distributions for my historical data. And to be able to do that, I will just click on, first of all, I need to launch my crystal ball. So far, everything was good, but I need to use crystal ball. And as you see here, I don't see crystal ball. So I will close my Excel file. I saved it. Now I will go to my desktop. And then here, I will click on AJ Apps. And then here, I will scroll down and find crystal ball. It's alphabetical. So right here, click on that. And then click Continue. And then click over here. Wait until it launches the Excel. Wait until you get this pop-up window. Click on Use Crystal Ball. Open the workbooks. Open other workbooks. And then browse and find the Excel file that we just created in my H drive. Right here. Now the Excel file is exactly the same, but the only difference is now I have Crystal Ball tab. Perfect. So now under Crystal Ball, I will use the Batch Fit option under More Tools. Batch Fit. And then next. Now I need to choose my data. Let's choose locational data series. Click on the small icon and go back to your growth rate, 5 years, and highlight A. That won't work that way probably. Just click on top left corner, A1, Control Shift right arrow, Control Shift down arrow, select the entire area, and then click OK. And now Crystal Ball recognized data is in the columns, perfect. And top row has headers, perfect. And left column has labels, that's perfect as well. So I have 5 data series, 5 different companies, and 59 months of data, almost 5 years, because I missed 1 month due to the fact that I can only calculate growth rate in second month. All right, next. I will let the computer choose the best distribution and use the best goodness of fit test. All right. Click next. I would like to create these results in the current workbook, in a new sheet. That's good. But I would like to make sure that show my correlation metrics and I would like to have the link fitted assumptions. This meaning that I would like to understand not only the distributions of each company, but also how correlated they are in terms of price. Meaning that if my software package generates a random number for company X, that's AT&T, and goes up, and if the AT&T stock price is highly positively correlated, linearly correlated with, let's say, in this case, Chipotle, I want those prices go up together or go down together. All right, so that's why correlation is very important. I'll click next. I don't need to click Microsoft Fit report, although it's pretty cool. I don't need to create assumptions report, which is pretty cool though. I will run my model. Now my model is done. You can see here that these green cells are my assumptions, and you can see the correlation metrics. Let's take a look at it. If you look at, for example, right here, 3M and Chevron is positively correlated and pretty high, I would say. It's not so high, but 0.5. One is the highest, negative one is the lowest. And as you see here, you don't have any negative numbers, meaning that there is no negative correlation. The weakest correlation looks like almost there is no correlation between CVX, which is Chevron, and Chipotle, which is a restaurant chain. So it's good to have not correlated, or even better, negatively correlated companies in your portfolio to be able to minimize risk. All right. So also, you can see that these are distributions that Crystal Ball found for us, the best distributions. And here, I really need to look at the p-values. And as you see here, the p-values are all greater than 0.05. So that means that I can use those distributions. However, for BNY Mellon, my software could not find any distribution. So no problem. What I'm gonna do is I will define an empirical distribution for BK, which is BNY Mellon. But before doing that though, let me just quickly show you what's going on here. I click on this cell, click on define assumption, and you can see the distribution, beta distribution for this company. There's a chance of growing in 1 month to over 10%, but most of my observations looks like around here. And you can look at if you click on correlate, you can see that the correlation is built in. That's perfect. Click OK. So now what I would like to do is click on gallery for BK. And then here I would choose all distributions and scroll down, and I will create my own custom distribution. And then click OK. Perfect. So now you need to click on this show more option, and then load data, and then click on this icon, and then go back to my growth rates 5 years for BK, starting from the first element, Control Shift down arrow, and click OK. All right, and click OK again. So I will use this empirical or custom distribution for based on real data instead of trying to come up with the best distribution, since I could not find any distribution with p-value greater than 0.05. And click OK. Now you can see that distribution is over there. If you don't want to slow down your computer, you can skip what I'm gonna do right now, but you could do, if your computer is fast, right click on one of those green cells and then crystal ball, and you can see here cell preferences, and then here you can show add command to the cell. You can show the mean value, click apply to, and I will apply to this to this sheet only, so that I'm not gonna slow down my computer a lot. Click OK, and then done. You can see that now the first distribution is custom distribution. Second one is log normal distribution with the mean, location, standard deviation parameters, and so on. And again, if you click on any of these and define assumption and then correlate, you can see that correlations are built in into these distributions. That's beautiful. All right, so now I found the best distributions and correlations between my stock prices. Now I can make my forecast, right? What I'm gonna do is, my forecast tab, I will create here first investment amount. So I assume that I will invest monthly certain amount. You can change this if you don't like to, but again, I'm assuming that you guys will have paychecks first in your lives and then invest certain part of that. So let's say I invest here $1,000 every single month. And I will assume that there's a discount rate, which is opportunity cost. I will assume for this person, the discount rate is 0.09, which is 9%. I'll assume that this number, because if you look at long-term, S&P 500 gives 9% return. And I'm trying to beat that. And I can convert this discount rate to per month. Let me just copy this. Control C, Control V, doesn't work. Control C, Control V. So let me just do this one as per month. Let's calculate this based on the yearly amount. So how am I gonna do that? So you guys know the compounding rate calculation. 1 plus 1 is your principal. Your rate, which is per year, to the power, I would like to convert from year to month. So 1 month is 1/12 of a year. And then I need to subtract at the end, my principal, which is 1. So you can see that equivalent of 9% per year is 0.7. So these are your inputs in your model. You can choose any color you want for these. Control S to save it. So now what I would like to do is, I would like to put the dates here in terms of months, future months. Maybe I should just say future months because I'm forecasting everything here. And I will start from 1, 2, highlight those 2, right down corner, black cross, drag it until I'm assuming that I'm forecasting next 60 months. Again, feel free to make it shorter or longer. But the longer you go to, the harder to predict, and it depends actually, but no one can know the future. So when you go so much in future, you may have hard time predicting. But some people, Warren Buffett kind of people, may say, hey, it is easier to forecast the future because short term we have so much noise in terms of randomness. Okay, that's not in the scope of this video. So what I'm gonna do is I will copy those names. I have 5 companies. Control C, go back to my forecast, Control V, and I would like to calculate here the forecasted growth rates. Okay, perfect. So now I can copy my batch fit assumptions, these 5. You cannot use Control C trick here. You need to go under crystal ball, copy, go back to your forecast, highlight the area, but you got to make sure that it has 5 columns because original data has 5 columns. And right here, I will click paste. Now it will take some time. I'm basically copying and pasting those assumptions that we just created. As you see, these are all assumptions in crystal ball. Perfect. I will press Control S, and I want to double check to make sure it's working. Click one of those numbers, green numbers, and define assumption. You can see that this is a variable distribution, which is good. And when you look at correlate, you can see the correlations built in. Perfect. Perfect. All right. So now what I can do is since I'm forecasting growth rates here, based on these forecasted growth rates, I can forecast stock prices in next 5 years, monthly. And I will use the same 5 columns, Control C, Control V, and I can basically multiply my forecasted growth rate times corresponding last stock price data that's available for me in historical data. Scroll down right here, 34.13. That was the last price that was available for me. So I multiply that with my forecasted growth rate. Now I can just drag it right, and right down corner, double click. So these are my forecasts. Is that right? No, because I need to look at here the previous month. All right, previous month times the forecasted growth rate. Now I can drag this one right, and on right down corner, double click. Again, first row is different because I make my forecast based on real data. The other months, starting from second month, is my forecast is based on forecasts, if it makes sense. All right, so now what I would like to do is I would like to forecast number of shares expected to buy with my $1,000 investments. All right, if I invest all my $1,000 monthly to buy BNY Mellon, basically I can buy $1,000 divided by stock price. Again, I assume I can buy partial number of shares, which you can in some platforms like Robinhood. All right, so I can just drag it right, but before doing that I need to lock my blue cell because I will use the $1,000 over and over again. And now I could just drag it right down corner, double click, and then Control S, and you can see here how many shares I expect to buy every single month in the next 5 years. All right, that is good. Now what I would like to do is Control B. I would like to keep track of my cumulative number of shares because these are each month how many I'm buying. Cumulative, again, these are all forecasts. Cumulative number of shares. Basically, I can assume that I can choose any of these companies individually. At the beginning, I had nothing, so I will just, the first month will be this exact same numbers, drag them right, drag it right, and the second month, previous balance plus new purchases right here. And now I can drag it right down corner, double click. So now you can see, restart the program. I guess I was too quick for Excel. All right, now Control S, make sure you are saving everything. Browse. Okay, save. Yes. Okay, let me just create a second version of this so that I'm not losing anything. Perfect. Okay, perfect. So that was scary, but we handled it. So you can see that if I invest all my money into AT&T stock, $1,000 each month, which is in 60 months, $60,000, I will end up, let me just, as you see here, numbers are so big to show width. I need to adjust the width. So I will click top left corner, double click. So you can see I will end up with, wow, over 1,400 shares of AT&T, which is pretty cool. So what I would like to do is also click over here under View tab. You will see Freeze pains. Perfect. You know what I would like to do also? I would like to close this because it looks like crystal ball is not running. So let me just close this, save it, and then I will do again, run the crystal ball. Wait for the pop-up window, use crystal ball, open workbooks, or you can just click here, the latest version that I just created. All right, so far so good. We are all good. So these are my cumulative number of shares forecasted. Now, what I would like to do is I would like to calculate my wealth in future dollars. Wealth in future dollars. So if I invest my money into these companies individually, what would be my expected wealth in future dollars, which is an easy test to calculate. So for PMY Melon, number of shares that I have cumulatively times the forecasted stock price and $1,000. And then I can drag it right down corner, double click. And so I'm getting so rich that Excel cannot show me. I would just go double click. Perfect. If you're talking about thousands of dollars, I don't really care about the decimals. So what I'm going to do is Control Shift right arrow, Control Shift down arrow, highlight this area, and I don't want to see the decimals. Perfect. As you see here, the best company based on my forecast on average is AT&T, which I would end up on average with $75,000, which I invest only 60 grand. So that would give me $15,000 extra, which is 25% wealth increase in future dollars. All right, but should I really work with future dollars? Maybe not. So let's convert all these dollars into today's dollars. Right now, what's the worth of those dollars? So I will copy this, Control C, paste it right here, Control V, and so it didn't work. Control C, Control V. Let's calculate wealth in today's dollars. All right, so now I would like discount all these dollars into today's dollars, okay? So let's discount this wealth by dividing by 1 plus the monthly rate, which we calculated here, discount rate monthly for one period, because this is month 1. So the power is 1. Since I will drag this one right and down, I want to make sure that everything is all right. So the blue cell, I don't want to do any changes. Perfect. The red cell, I don't want to do any changes, but looks like, one second, what's going on here? Looks like there is an issue here. 1 second, let's do it one more time. Let's discount these dollars, divide by 1 plus the discount rate per month, and I will keep using same discount rates for F4. Close my parentheses. How many periods? I will discount it by 1 month. However, when I drag it right and down, I don't want this A4 to go B, C, D, and so on, but I want to go down. So F4, F4, F4. So I need to just lock the letter, not the number. Perfect. And then I need to subtract. No, I don't need to subtract anything. Sorry about that. So this should work. Enter. Right down corner, drag it to the right, and bottom right corner, double click. So you can see now that if I invest my money into AT&T, that each $1,000 I invested, today's dollars, assuming that 9% annual discount rate, is going to be $48,000. What does it tell you? If I had $48,000, $48,762, I could invest in S&P 500 on average, get 9% per year, and that would end up being exactly same as what AT&T is offering me, which is $75,000. Okay, so that's what it tells me. All right, so that's how we convert the future dollars into today's dollars. But also, let's take a look at these are our wealth, but let's take a look at our investments. I'm curious about my investments as well. So let's create a column here called investments in future dollars. All right, investments in future dollars. So what I'm gonna do is I will just assume that $1,000 invested every month, F4, and then right down corner, black cross, double click. So I would like to also discount these to today's dollars as well. So investments in today's dollars. All right, so let's discount these as well. Similarly, future dollar divide by 1 plus the discount rate, which is per month, because all my calculations are per month, 0.7. Lock this cell, F4, and then I need to discount this since this is month 1 month. So I will just click here. I want to make sure this is locked horizontally, F4, 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 and then press enter. Now we can do this. So what does it tell you again? $1,000 invested 5 years from now or 60 months from now is virtually $650 today, because I could compound $650 with 9% return on investment alternative and make it $1,000 5 years from now. All right, beautiful. So now, next thing I would like to do is I would like to keep track of my investments in cumulative today's dollars. So right down corner, drag it right between two of these columns, double click to adjust the width. Investments cumulative, C-U-M-M, cumulative. All right, so the first month is going to be obviously itself, but the month after, previous balance, invested plus new investments. All right, right down corner, double click. Perfect. Now, what I can do is I can calculate my cumulative profit in today's dollars. Cumulative profit in today's dollars. All right. So again, I have 5 companies. Control C, Control V. Didn't work. One more time. Control C, Control V. Perfect. Now I can calculate my profit in today's dollars. I'm assuming if I sell my portfolio at the end of the first month, it's my profit. Wealth, in terms of if I invest everything in BNY Mellon BK minus what I invested. All right, so since I'm gonna drag this around, I will keep the blue cell the way it is, but this one, I don't want it to move horizontally. F4, 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 enter, drag it, right down corner, boom. So now you can see the profit. So I feel like we referenced it somewhere wrong because all the numbers are negative. Let's see whether that's the case. Interesting. Just scroll down. So I'm losing so much money here. Maybe there's a miscalculation somewhere. Looks like these companies do not beat 9%. Okay, it's fun. Let me just change the discount rate to 0, assuming that currently, actually, literally Fed just tonight, today is March 15th, 2020, literally Fed decreased this rate, risk-free rate, to 0. Let's assume that my discount rate is based on risk-free rate, which is you cannot make any money nowadays with your money. All right, so now let's see what happens to my investments. Still, I'm losing money in CVX. What happened to CVX? I'm just curious about this. All right, so CVX stock price was $83. And my forecast is actually CVX to go down. Wow, that's crazy. Because historical data, let's take a look at historical data. Looks like I chose the companies that I think value companies that are hammered last 5 years. And let's see CVX, what happened to Chipotle. Sorry, not Chipotle, it's Chevron. Yeah, oil price obviously decreased a lot. Currently it's $30 per gallon. It was like 130 or something like that several years ago. Look at this, 83.42. It was 90. Wow, Chevron was much more expensive than today. Chipotle, 630 right now. It was 621, almost nothing. So you can see that these companies got hammered. So that's good. That's what I expect to have. That's why I do actually this analysis right now, so that you guys can see the effect of a downturn crash. And we are still at the beginning of this crash. All right, so looks like no one is, it's very risky time frame right now. That's why also I want you to see that this kind of analysis based on price is very dangerous, because it's all about momentum, and it looks like momentum is downward now, and my model is assuming that things will go worse and worse. So that's why I personally don't like to do price-based analysis like this, but I think it's a great exercise, and there are many momentum investors, traders out there that use this kind of models. All right, so now we can calculate the return on investment. Return on investment. I will calculate these values annually. All right, for these 5 companies, Control C, Control V. Let's calculate return on investment. So what's the return? This number. What is the investment? They have to agree to each other. They are all today's dollars. This is the amount. So this is my return on investment. So I need to lock my red cell. F4 horizontally. F4, F4, perfect. And do it this way, right? Drag it right, double click, and these are percentages. And you can see your returns of the investments in percentages. However, I need to consider time frame as well, because this 17.7 is not a fair comparison, because assuming that I buy my shares throughout the next 5 years and sell them everything at the end of the 5 years. However, that's not fair, because in this case, for example, it's just I had only 8 months to consider. So to make all of these returns annualized, what I'm going to do is, again, same trick, 1 plus the rate for the period that I calculated to the power. I would like to convert everything to 12 months. And this is actually 1 month time frame. All right. 12 divided by 1 in this case. And then at the end, I will subtract my principal. So I need to lock my purple, obviously horizontally, F4, 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 and that should work. I can just do right, double click. So these are all annualized returns you can see for these companies. All right, so now what's next? So these are all my return investment expectations if I assume to sell in the future. So, okay, now what I'm gonna do is I would like to create my forecast based on these values, okay? My forecast is I'm trying to figure out what happens 5 years from now. So these 5 results. So I will define these ones as my forecast. Click crystal ball tab and then click on define forecast. My first one is BK 5 years, at the end of 5 years, annual ROI. And I will just copy this, Control C, click OK. Next one is CMG. I lost the copied. I will type again. CMG 5 years holding period, annual ROI, return on investment. Control C. Hopefully this time it will work. OK. Control V. And third company is Chevron, which is CVX. Okay. Fourth company here is 3M, MMM. Okay. And last company is AT&T, which is T. Okay. So I create my forecast. Now, what I would like to do is also create a portfolio. So let me just create a portfolio based on the given weights. Let's assume that I first put everything into my best company. Looks like in this case is AT&T, 100% here. And then let's put 0% other ones, other 4 companies. Their percentages. All right. And let's calculate the total here. Total percentage, which is the sum of this row. Perfect. And let's create our portfolio outcome or forecast here. Which is based on the weights and expected returns. So expected returns are here, comma, my weights. Okay. So you can see here that if I invest my money into 100% AT&T, obviously my expected return will be same as AT&T itself, right here. Let's define this as a forecast as well. On the crystal ball, click on define forecast. Let's name this one as portfolio. All right, perfect. All right, now I'm ready to do some fun stuff. I will click on OpQuest. Oh, I need to define my decisions. Perfect. So these are my decisions. I will try and decide on these. I highlight these 5. Click on define decision. First decision is what percentage of my portfolio goes to BK, which is BNY Mellon. Just Control C. And I want to put minimum 0, no short selling. I'm assuming a maximum 100% of my portfolio can go there. Click OK. Second decision here is my CMG. What percentage of my money portfolio should go to Chipotle? Minimum 0%, maximum 100%. Click OK. My third company here is CVX, Chevron. CVX, my minimum 0, maximum 100%. Click OK. My fourth company here is 3M. Minimum 0, maximum 100%. Click OK. Finally, my last company is AT&T, T. Minimum 0, maximum 100%. And then click OK. Perfect. I defined those decisions. Now I can click on my OpQuest. And here I can define my objective. I would like to, let's say, minimize the risk, and I will measure the risk in terms of coefficient of variation, which is the standard deviation divided by mean for my portfolio. I'm trying to minimize my risk. And I would like to add a requirement. I would like to have my mean of this portfolio greater than or equal to, let's say, 0%. I don't want to lose money on average. And I would like to create efficient frontier for my portfolio. Let's say, since these returns are pretty low, I would like to choose from 0 to maybe, I would like to cover a crazy range, because you may find really, really good companies with great 5 years performance. So let's say 30%. And I would like to see the values with maybe increment steps of, I don't want to create way too many because it will take forever to run the model. Let's say 3% increments. All right, so now I will click next. These are my lower bounds, these are my upper bounds, these are my current situations, these are my 4 companies. Constraints, I want to make sure that I invest all my money. So click over here. This is the total. I want to make sure that I invest all my money. Not more, not less. 1. And I don't want to run it way too many times because it will take so much time. Let's say 30 simulations and then run. Okay. Yes. It will take some time. Now my software is trying to find the best solutions for me. Again, I'm doing 1,000 trials. I could decrease this to, depending on your speed of your computer, please do whatever you must do. And for 30 simulations and different thresholds. So I chose 10 different thresholds. Actually, this will take some time, but I think that's okay for this video. And in your own analysis, you can basically just run the computer, have your lunch or dinner or whatever. While this is running, maybe I should stop this because this will take some time in terms of video, but you could do this for your own analysis and wait. So I will just stop this because I don't want to have very long video. Okay, so what I'm gonna do is I will decrease my trials from 1,000 to 100 for this video purposes, and you make your own judgment for your own analysis. And then again, OpQuest, and instead of 3% increments, I will do 5% here, and instead of 30%, maybe I will just do 20% here, so that I will have less number of trials. All right, next, and let's say for this video purposes, let's say 20 simulations for each run. Okay, let's run it. Hopefully this won't take that long. Okay, so you can see that I get one feasible solution here that return ended up being more than 0%, and my coefficient of variation is over 100%. Return on investment is 4.4%. So while this is running, let me just quickly show you what's going on in the market right now. It is pretty insane. Let me just go to SPY. I just don't want to waste time in the video while it's running. I want to show you what's going on. This was 11-year bull market, and people were saying that this will go on and on and on and on forever, right? But we realized that that's not the case. So you can see here that this was 11-year bull market starting from 2009, January 1st. So that's 82, and it went all the way up to against 314. So it's like almost 4 times. But now take a look at this. What's going on in last month from 340 to it went down all the way down to 270, which is like almost 30% off, and it's coming up a little bit with Fed rate cuts. But I'm looking at S&P 500 futures, which is future contracts. This should go even further down in upcoming months because of the coronavirus, they say. But obviously, I was predicting this over 2 years. It's not just because of coronavirus. My simulation is still running, by the way, 55% complete. While it's running, I can tell you what are the things that I look at. I look at Schiller PE to be able to show what's going on in the market. So this is, as you see here, 140 years. It was extremely expensive, and I have been saying this since 2018. This is not sustainable, and it dropped quite a bit, and then Fed cut rates and then went up again, and as you see, it's still going down. But you can see that the average is 16.7, and currently the price divided by earnings is extremely still high, 25. So this can go another 20% or so. If you look at the PE ratio, price to earnings, instead of Schiller PE, which is last 10 years of earnings, you can see still the average is normally 15.7, that's a 16. Still, we are talking about 20% higher than historical average. So if this goes 20-30% more down, I wouldn't be surprised. And this is what happened to Treasury yield. Look at this. This is 140 years low. People are attacking to US government bonds because they're so scared. Okay, that was just a filler. Let's see what's going on in my analysis. Is it done? 95% done. I still need 5 more percent. All right, optimization is complete. Click OK. Perfect. So now what I would like you to do, and I would like to show you, is that create my optimization report. I click on Crystal Ball. You can see here that I can create under Analyze, create a report. And I will create OpQuest report. Click OK. Now let's see what happened. I just scroll down. All right, so you can see that this portfolio tried different thresholds of returns, and looks like these 5 thresholds constraints gave infeasible solution. What does it tell you? So if I choose these 5 companies based on price data, there is no way I can beat 5% return on investment. I cannot beat 10% and 15 and 20% either, because if I cannot beat 5%, how can I beat higher returns? So if I keep my required rate of return annualized 0%, then I can get 4.4% return on investment, and that 4.4% return on investment would give me 106% of coefficient of variation, which means that my standard deviation is slightly bigger than my return on average. So it's quite high here. So I would like to look at these 2 numbers when you create portfolios, and I can compare what's your return, what is your risk. Please share these values with me, this table with me, and the higher, I would like to have higher returns and lower risk. Let me just show you a few more things before I finish this video. On the Crystal Ball tab, I can click on view charts and forecast charts, and I would like to see what happened to the individual companies here. 1, 2, 3, 4, and 5. Okay, let's take a look at the portfolio as well. I will open them up. So here is one thing that, okay, no data available, perfect. So maybe what I could do is, okay, so this is one thing that I want you to do, portfolio optimization. Let me just save this before I do anything crazy. Save as, browse, and I will save it in my H drive. Opt quest report. That's what I'm interested in. Save, but I would like to close this one now since I saved it. And I would like to run this model for 100 times for now and see what is going on. Let me just reset this. All right. So what I would like to do is run this model. And I would like to show you one more thing. Instead of opquest run, I want to run the model directly. And I want to show you something here. So this portfolio, you can see that probability of losing money, if I put 0 here and press enter, is 25% the portfolio. And if I put the, let's say, my goal of making 9%, not 900%, 9%, the probability of not having 9%, 86%. So let's say risk is here losing money, 25% chance of losing money. And if I look at here for AT&T, probability of losing money is also 25.3%, which is kind of interesting. Okay, because again, they are 100%, we assume they are the same thing. This is not a portfolio optimization. So this one right here, 47% losing money, 3M. And for Chevron, 64%. Looks like if you define the risk as losing money, Chevron is the riskiest company. And if I do for CMG, which is Chipotle, 47%. So it looks like there's quite a bit of chance of losing money because of the, again, this is impacted a lot by the coronavirus, and banking is also hammered. Banking, airlines, and restaurants and oil companies are hammered in this crisis. So that's why I chose these companies, and you can see they're really, really bad. So let me just show you creating a report for this, for the forecast. And here I would like to show you some interesting things as well before I finish this video. So if you look at it here for the BNY Mellon, so you can see that on average return was -1%, all right? And coefficient of variation was crazy high. It is like 500%, always negative because my return is negative. So it's very high, 5 times, standard deviation is 5 times of the mean. So if I look at the Chipotle, average return is 1.4, not too bad. And you can see that the risk is 600%, like 6 times of correlational variation. And let's look at our third company, which is Chevron. The average is -1.4%, which is not awesome at all, losing money on average. And coefficient of variation, again, huge, almost 400%. So this is bad too, very high risk. If you go back 3M, again, return is 0.8%, and coefficient of variation is huge, horrible, or almost 600%. So why am I showing you all these things? I will show you one interesting thing before I finish my video. You can see here the return is 3.4%, and you can see the correlation coefficient of variation is over 100%, 131%. Okay, so now I want you to see one thing here, that the portfolio that I created based on optimization model, let's see what happened there. I just saved that. Was 4.4% return and 106 coefficient of variation. So what does it tell you, right? That's an important thing to know. This portfolio, actually, I wish I could see the portfolio components here. It looks like I need to rerun the model to be able to see that, but it's okay for now. You guys can figure that out. What I would like to do is compare this versus this. Look at this. My coefficient of variation is 106%, which is even much lower than any other coefficient of variation, even this one, right? Even it's lower than 131% of the AT&T stock. I believe it's AT&T. Sorry, AT&T's here. AT&T coefficient of variation is 131%. So you can see that my portfolio ended up being much less riskier than my individual companies, because again, when you put multiple companies in one basket, that will create minimizing the risk. And my returns are instead of negative numbers we see for some companies, my return for my portfolio is 4.4%, which is, I would say, not too bad. It's greater than 3.4. It's greater than 3.4. It's greater than 0.8, and so on. So again, if you want to maximize your return on investment, you can put a bunch of companies together, and that will help you to create a great portfolio. So before I finish this video, let me just save my report as well. All right, and that's it for this video. Until next video, enjoy business analytics.